Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, like we normally do. I'll interject my financial opinions as we go, generally related to wealth building, commodities, and or financial topics. So let's get in there. Let's see what's going on and what people are sharing. If you want to follow me, it's at funding_finance. And if you want to join our community, finding-value.com is where I dive deeper into the individual companies, individual sectors. I share my opinions. I do a midweek update every Wednesday of what I'm doing and what I think looks good. And we also have the question and answer sessions on either Saturday mornings or Sunday afternoons to get the widest range of people to be involved in it. So we do have a LEAP coupon code that is still active, LEAP. If you are interested, look in the description link below. So Gold Silver HQ, the quote is, by taking capital out of the system and putting it into gold and silver, you're out of the system. The whole idea behind gold and silver is that they cannot bankrupt, according to Bill Holter. Now, I get a lot of questions on if you have to pay a premium or a fee to take money out of the system and buy physical metals. Is it worth doing? Or is going into an ETF a better solution because it is cheaper to transact in and out of the ETF? And I'll just say I prefer the physical metal. And if you can figure out ways to acquire it at the lowest premium over spot, that's what I would do. Because it's a way to diversify your money out of the system. And that's very important to me. I don't want to transact through the dollar, or you have risk that is subjected to the brokerage that you are in and the risk of the ETF itself. So there's all this risk with buying an ETF that you don't have buying the physical metal. Now, I did look at the premiums that I am paying for some of the metals that I'm buying. I am paying about a 4% premium, about 4% over spot price is what I'm paying for physical platinum at this time. If you're paying more than that, then you should join the website and you can see exactly where I'm buying it from. If you want to see where I'm buying, if you want a savings. But that's what I'm paying, about 4% over spot at the current price. And that's for paying for it through an electronic check versus, a credit card. But a credit card may actually be cheaper depending on the points system that you have with the credit card. Because I did notice that it's only a 2% discount, which means if your rewards on whatever card are at 2% or greater, you would actually net a net benefit by buying it through a credit card versus the e-check. Just an FYI. So coming up, Unusual Whales says, a prediction from December of 2023, which it's not that long ago. The Federal Reserve will cut interest rates 6 times in 2024 as the economy shows clear signs of cooling down, ING says. And here we are with inflation running hot. The economy will probably slow down. That would be my guess to some extent. What are they going to do? I have no idea. And all these guys making predictions, they seem to get this wrong a lot. Even the Federal Reserve and some of the things that they have signaled to the markets have been vastly wrong. I mean, I don't even know what to believe anymore. They said in 2020 that we weren't going to see rate cuts till sometime like in 2024. That's what they said. But we look at reality, we had the fastest rate hike in the history of the markets. That's about as far opposite as you can get. You signal that you're going to do zero rate cuts till 2024 and you have the fastest rate hike in history. Think about that for a second. I don't believe anything they're saying, and I don't really believe that any of these people actually know what the heck's coming. So I would be very careful with predictions that you're reading either on Twitter or listening to on YouTube or listening to on Twitter, I guess. I would be very careful. Here's Rashad. Can't say his last name. Silver is consolidating under key resistance line, and it could take 2 to 3 months before it explodes above the $30 mark. Present consolidation is similar to that of 2010, which I completely agree with. Following which silver rallied 155% within 8 months after that key breakout. So looking at this, we've got a line going across here at about 27.30. The resistance, the last line of defense, is about $30. We can see that, let's zoom in on this bad boy. We can see that last fractal here, this is called a fractal. We came up to the resistance line, hit our head on it, pulled back, came up again, hit our head on it, pulled back less, and then we went into a kind of a dead period here, where we just go sideways. The dead period is where I call it where the buyers equal to sellers. And then we ripped. We came on down, we did basically a double bottom. You can put a line across here. It's a lead-in pattern, one double bottom here. Before a big move, sometimes you get this yank down. It's a washed out sale, which creates a false move, which was 2020, and then the slingshot higher. So that was your false breakdown slingshot. We had a nice little consolidation here, which is basically the same consolidation as this in terms of the pattern before we could have a big run. I don't try to time this short-term, little move sideways here, which we definitely could get. Think of it as interest rates going up at the same time that gold and silver consolidate slightly lower to sideways. That's kind of what I think is coming. And then we'll see boom. We'll see a boom in silver, and maybe we go to levels that are unimaginable for some people. Brian Feroldi, yeah, says bad investors only focus on the upside. Good investors study the upside and downside potential. They weigh each carefully and only act when the odds are heavily skewed in their favor, which is true. And what we call that is asymmetry. Symmetry is where you've got equal upside and downside. They're both equal. We're looking for everything stacked in our favor and huge asymmetry where the upside is far multiples higher than your downside risk. So think of it as 10 or 20 times upside with like a 50% downside, 40% downside move. If you're getting into the stuff that's really volatile, that provides that type of leverage, you still have 40% downside risk no matter where you buy it. It is really hard to catch the bottom of all bottoms. A lot of technical investors wait for the bottom to occur and buy it when it's going into strength to the upside. If you're brave enough and you adopt some of the strategies that I use, like ratios, market conditions, and potential technical analysis, sometimes you can identify fractals, which is repeating patterns over and over again, and you can try to time a bottom and cost average in at a very low price if you're a patient investor. So that is what I try to do, and I've gotten better over the years of investing, and I've really worked on my patience to try to master this game. This is something that I really want to try to master and get very, very, very good at. So it's fun. I treat it as a game. Houseflation is heating up around the world as central banks lean towards cutting. So here it is coming back up. The only one that's still kind of negative for what is this? Global house prices rising, not typical of Fed easing cycles. That is really weird. So generally, when you get an easing cycle, it's caused by the real estate cycle, where you build too many homes, inventories go up, you get a recession because we've built too many homes and credit gets destroyed. That is a lot of the recessions, not all of them, but a lot of them. So when they pull back on yields, when they lower yields, it's because the weakness is already inherent in the housing market. Unemployment's going to come no matter what they do to interest rates, and things collapse along with credit collapsing. That is your recession, and that is where the majority of recessions are rooted in. Now, if that was the case, we would be seeing home prices starting to ease, and we've got the exact opposite here. It doesn't mean it can't roll over, but we have been moving up since 2023-ish. That's what I meant by the slowdown could already be behind us, and we're getting strength here. And why some of this is very difficult to nail, because you've got a yield curve that's inverted. A lot of people look at yields to drop. That's why we're seeing all of these predictions that yields will drop, and yields aren't dropping. We have a strong housing market in terms of pricing. We have poor affordability. But if rates decline, I think the affordability will go right into a bunch of people who are wanting to buy homes. I think prices will go up substantially if they were to lower rates substantially. And it's not because rates are the driver of home prices. That is the wrong mindset. It's because the affordability and the demographic wanting to buy homes. If the demographic didn't exist, we wouldn't have that same setup. Coming on down, we've got Jesse here. He says, I agree 100%. I expect stocks, bonds, and residential real estate, which are all wildly inflated right now, to fall dramatically against gold in the upcoming financial system reset. Owning gold is the ultimate way of shorting the everything bubble. And what he's responding to is the comment that all commodities and assets will revalue in sync with gold. It will be an across the board rearrangement of prices. And I expect wages and asset prices that depend on leverage will collapse relative to gold. So people are afraid of the leverage aspect. And maybe that's where I don't know how this will play out. They are speculating that the problem will be in leverage, and that gold's going to kind of protect you against this everything bubble. What I'm afraid that's going to occur is we have an everything bubble that starts to pop. They don't want it to go down because that's where large tax revenues come from for the government. And they have to keep everything inflated. I'm afraid they're going to inflate massively. I mean, stuff that you've never seen before. And that's kind of what all the charts are suggesting. So these guys who think gold will do well in that scenario, but these guys who think that kind of everything will fall that has leverage, I'm not 100% sure about that. I'm not taking that bet. I'm gonna stay long because I think inflation is coming, and I think that will be one of the forces that could cause even more spending and money printing. John says value of $10,000 invested in 20 years ago. So we were in a big recovery phase from 2011 till today. And a lot of the regular stocks perform really well under those market conditions. So Nvidia, Apple, Monster, Booking, Netflix, all returning over $1 million per $10,000 invested 20 years ago. All of those companies. Now, this is the symmetry that is provided to you. That is what symmetry looks like. Now, I don't think everyone can nail 20 years ago all of these companies. But I can tell you this, I knew Apple was good 20 years ago when I first saw the iPhone. I was like, oh, dude, they're going to kill it. They're going to absolutely wipe it up um, with that phone. I knew it right when I saw it. Monster Beverage was actually called Hanson Natural, I believe. And I owned a lot in Monster Beverage myself. I owned Hanson Natural way back in the 2000s, in like the late 2000s. Um, Netflix, Salesforce. I knew Google was going to kill it. Everyone knew Google was going to crush it. And what I want you to take away here is $10,000, and some of these are well over 100 baggers. You won't pick every single one of these companies, but I bet you over that same time frame, you could have easily picked McDonald's and Nike. You could have easily picked Google. You could have easily picked Monster if you tried that out, and Apple. That wasn't a hard pick. But what did you have to do? You had to hold 20 years. And most people aren't able to do that. And that's where all the returns are in compounding. You find a really good company, even if it's very obvious. I'll name an obvious one: MasterCard, Visa. Those are two obvious picks that I saw them when they went public. And I was like, dude, they're going to make money. Like everyone uses this at the gas station, everyone's using it at all of these stores. I saw it everywhere. It was just obvious to me. Chipotle was another one that I participated in, and I still didn't hold long enough. I could have made even more money if I held longer. So that was one of the biggest lessons that I've learned is I need to hold even longer than when I am. Here's Mac 10. I predict that all of the risks that disappeared this past week will be coming back next week like they were never gone. And a lot of people are trying to make these topping call moves, and I do think it does look like a top. Not going to lie, but I'm not going to try to short this or do anything with it. Inflation can push these things up. I'm not in that game. I'm going to play the inflation sensitive assets and go long. I don't want to try to predict tops or try to short anything, but this is a possibility. And if this does materialize, they might print money, guys. They might just print a bunch of money. Jesse says exposure to energy has been meaningfully lower only in late 2015 and during the shutdown there. So low exposure to energy is well below average. Hedge fund exposure is just off all-time low. And what I'll say here is, you guys who've been on the website with me, we're in a lot of energy service companies, and we're in a lot of energy exploration, production, and coal, and a lot of other things. Does this seem like that has low exposure? Because the returns on some of those have been absolutely fantastic, multi hundreds of percents from the bottom in some of those investments. Imagine if this were to go back to a historical high, or higher than where it is today, which is at a historical low. I think we are going to be in for a very big move. I think that energy is going to be posting these types of gains in the future. That's where I think the opportunity is if you can hold for 10 years or something like that. Coming down, global inflation remains undefeated. A key force for disinflation, falling commodity prices, has essentially hit a wall. Falling commodity prices has. The world is at a vulnerable moment. A major energy shock could undermine much of the progress in reducing inflation. Here's my question. How did oil prices get this low? Well, we released a whole bunch of oil from the Strategic Petroleum Reserves, didn't we? Should oil prices be this low? Big fat question mark. I don't think so, guys. I don't think they should be this low. I think they are unnaturally low because of all the SPR releases. The natural tendency of this market for oil is in a bigger deficit than what we actually experienced and observed by all the SPR releases. So I think we have a lot of upside potential. That's what I think. The question many are asking is, If you will no longer accept credit cards and bank transfers, how will I pay? He says, I like the idea of having a conference once per year, perhaps in international waters, in which gold and silver are presented for services rendered. No taxes, baby. Yeah, that sounds actually pretty interesting there and pretty cool. I wonder if more countries are going to do stuff similar to that. And I know he's saying that from an individual standpoint, but that does sound actually quite interesting. U.S. interest payments in 2025. Guys, look at this. This is going vertical here. April of 25, 1.2 trillion. April of 25, 1.7 trillion. And I think the projections there is the projection is assuming that rates are stable in the blue line. The yellow line down here is assuming that we get a 150 basis point Fed cut. And that's April of 2025 from basically where we are today. I don't know what's going to occur, but both of those lines are upward quite substantially. The blue line is ridiculous. And that's a lot higher for longer. What if interest rates go up? This is going to go off the page here if we get even higher rates. And I do think that China and some of these other areas are probably trying to do that. Financial warfare. Watch the business, not the stock. I've talked about this before where there are two separate entities. And what we're trying to do is we're trying to value the business and catch it when it's down here or down here, where the valuation is low. That's exactly what we're trying to do. Jesse says, don't expect a supply response in energy until CEO compensation incentives revert to production goals. Guys, look at how low this is. This is energy capex as a percent of operating cash flow, and we are really, really low compared to history. I don't know if we're going to get a big move in production higher, guys. This is going to look real interesting here. Very interesting. Great Marti says, major banking crisis. U.S. prepared for potential failure of a major Wall Street bank, according to the FDIC. It says, really? To understand the future, we must look at the past. So below depicts 1970s versus the 2024 yield comparison. And what he's looking at is fractals, fractal analysis. The symbols are uncanny. Today's problems are far greater, end of the financial system greater. One can clearly see that it cannot stop until something breaks. The U.S. is not prepared for a major bank failure. The entire banking model works on insolvency that entrusts its customers to keep paying on its debt. Yields are about to make that a lot harder. Quadrillion derivative bubble once it all unwinds. It's game over. God bless and Godspeed. So he's comparing the moves from 1981, big downward move of the 40-year downtrend in rates, the broken downtrend line to the upside. And this is very similar to 1915, the declining interest rate environment. We broke that in about 1960 something, or sorry, 1950s, mid 1950s. We broke it, did a retest, then we were moving on higher in the 60s, late 50s and 60s. Very similar to where we are at today. Coming on back. Eric Yoon says, silver stackers are getting robbed in the U.S. Buyer here. He says, my coin dealer turned away 2 monster boxes of silver eagles at 25 bucks an ounce. People are dumping silver and gold, and his inventory is full because silver stackers and gold are not buying because people are hurting financially. I'm a silver stacker, but the key is buy low and hold for the long haul just in case the economy collapses. You could borrow or trade or food and trade with the community. So that is also something that is going on is we might be seeing a little bit of people who need to sell their precious metals because of financial situations. And maybe that's what moves us sideways a little bit in the metal pricing. We have to kind of get through people who need to survive selling some of their metals. It says the first law of capital allocation is that what is smart at one price is dumb at another. And that's your value. What is smart at 10 bucks is dumb at 40 bucks. It's just your value that you have. Here is Patusa research. Gold drilling falls to an 8-year low. The year started strong, but March 2024 witnessed a significant slump in all drilling activity. Project numbers dropped 40% to only 178, the lowest since May of 2020. Drilling fell across all development stages. Late-stage projects decreased by 44%, mine sites by 43%, and early-stage efforts by 33%. And this is project drilling activity by commodity, February 2022 to March of 2024. And here's February 2022. And look at the decline in activity for exploration in these commodities. This is number of distinct projects drilled, exploration price index. Down, down, down. So we are actually drilling less for exploration. It's going to be a bull market coming, guys. The Great Marti, Russell 2000, market cycle psychology. There's a reason why such a chart exists, studied and researched over many decades, which in turn provides the tools to prepare for what awaits. Wall Street never changes. The pockets change. The suckers change. The stocks change. But Wall Street never changes because human nature never changes from one's private perusal and joy. And what he's got here is the stock market, S&P and or NASDAQ, I don't know which one, U.S. Small Cap 2000 Index, that's what it is. U.S. Small Cap 2000 Index. And this looks like we're going back to normal, but this could be a big move lower. What is going to cause that? Interest rates. Interest rates are going to cause that and a weakening of the economy. So that is where a lot of the weakness comes from, is the interest rates going up and the net present value calculations pushing lower the fair value of stocks. People are less willing to speculate if they can get a higher return in bonds. Investment wisdom. Warren Buffett says the biggest thing about making money is time. You don't have to be particularly smart. You just have to be patient. And I've been hitting on that a lot. Patience is a big deal when you're trying to make a lot of money. Here it says, this is a very rare event, only happened 3 previous times in 140 years. Bookmark this chart as it's one of the most important macro cycle charts out there. This is the S&P 500 priced in gold, and the 7-year rate of change giving a very clear indication that a precious metals bull era can embark. And again, that ties in with this technical analysis we're seeing on the Russell 2000 here. So this is 140 years of U.S. stock price in gold. And you can see every time we had a rollover, it was beneficial to be in gold or precious metals. We have a rollover and we're getting another rollover here potentially and breaking the trend line to the downside. You can also see that the momentum, every time it went negative, it was a great time to own precious metals. And we're about to go negative again. So we're going to a gold and silver bull era here very shortly, based off of this data here. Buy low and sell high. Natural gas is currently retesting the lows of its prior 7 major bottoms. If you ask me, it's time to step in. Yeah, I agree. Nat gas is cheap. You can see all these bottoms where you'd want to purchase. It says there's a rumor that the Chinese are right now in negotiations to invest in an African uranium developer. Oh, that's interesting. It says Justin Garo. But that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Still have LEAP coupon code going on. I just uploaded the question and answer session that we did earlier today, which now was yesterday. So that's all I've got for today, guys. We'll catch you later. This is Finding Value.